Michael Burry, the hedge fund manager portrayed in The Big Short, gained fame for predicting the collapse of the US housing market before the 2008 financial crisis. Rather than shorting stocks or mortgage-backed securities directly, Burry used credit default swaps and long-dated put options to profit from a market downturn. Put options allowed him to gain as the value of housing-related securities fell, while limiting his downside risk to the premium paid for the options. This strategy showcased the power of options, the ability to achieve significant returns from relatively small investments through carefully constructed asymmetric risk profiles. His success is a powerful illustration of how options, when properly understood and deployed, can serve as effective tools for hedging, speculation, and capturing market inefficiencies. An option is a financial contract that provides the buyer the right but not the obligation to buy, call, or sell, put an underlying asset at a specified price on or before a specified date. Options are derivatives. Their value is derived from the price of another asset, such as a stock, index, or commodity. Options are used for hedging existing positions, speculating on price movements, and generating income through premium collection. Options can be traded on regulated exchanges, standardized, or over-the-counter, customized. Call options grant the holder the right to buy an asset at a predetermined price, strike price. Put options grant the holder the right to sell an asset at the strike price. Example: if you buy a call option on stock Tesla with a strike price of $400 for $15, at maturity, if Tesla closes at $450, your payout is $450 minus $400 equals $50, and your profit is $50 minus $15 equals $35. If Tesla closes at $300, you don't exercise and your payout is $0, and your loss is your premium, $15. Strike price is the agreed price at which the asset can be bought or sold. Expiration date is the final date the option can be exercised. Premium is the price paid to acquire the option. Intrinsic value is the difference between asset price and strike, if favorable. Time value is the portion of the premium related to time until expiration. ITM, ATM, and OTM, in the money, at the money, and out of the money, indicate moneyness. Call option buyer has unlimited upside potential and maximum loss limited to the premium. Put option buyer sees maximum gain if the asset drops significantly and loss is limited to the premium. Call option writer receives premium but faces unlimited risk if the asset price rises. Put option writer profits if price stays above strike but faces high risk if asset price crashes. These profiles can be plotted graphically as payoff diagrams, a vital tool for understanding options behavior. Portfolio insurance involves buying protective puts to hedge a stock portfolio. Leveraged speculation uses call options to bet on a price surge with minimal capital. Yield enhancement is achieved by selling covered calls to generate income from stock holdings. Directional bets allow investors to express bullish or bearish views without large capital outlays. Options provide customizable exposure to market outcomes, making them essential tools in both institutional and retail strategies. Options empower investors to fine-tune their market exposure, hedge existing risks, or speculate with defined downside. But this power comes with complexity. Options require a solid grasp of their mechanics, payoff profiles, and the risks associated with both buying and writing contracts. In this module, we will explore how options work in detail, from the Greeks and pricing models to real-world trading strategies that apply these concepts across different market conditions. In institutional trading desks like those at Goldman Sachs or Citadel, options are managed not just by looking at direction, but by analyzing their sensitivities, known as the Greeks. For example, A trader may hold a large book of S&P 500 options and monitor its delta to understand directional exposure, gamma to assess non-linearity, and vega to gauge volatility sensitivity. These metrics help traders adjust their positions in real time to ensure the portfolio remains balanced regardless of market swings. A desk might neutralize its vega if expecting a volatility drop or hedge delta exposure after a sudden index rally, illustrating how option pricing models are at the heart of modern derivatives trading. Options derive their value from two main components: intrinsic value, which is the immediate profit if the option were exercised now, and time value, which is the extra value based on the time left to expiry and volatility. Mathematically, the option price equals intrinsic value plus time value. Factors that affect option pricing include the price of the underlying asset, strike price, time to expiration, volatility, risk-free interest rate, and dividends for stocks. One of the most widely used models for pricing European options is the Black-Scholes model. It assumes constant volatility, no dividends, European-style exercise only at expiry, and a log-normal distribution of returns. While it has limitations, it remains foundational and introduces the core sensitivities known as the Greeks. Delta is the sensitivity to price change in the underlying asset. It measures how much the option's value changes per $1 move in the underlying. For call options, delta ranges from 0 to 1. For put options, delta ranges from 0 to -1. Gamma is the rate of change of delta. High gamma means delta can change rapidly with small price movements. Gamma is important for managing portfolios near expiry or near the money options. Theta represents time decay. It measures how much value an option loses per day and is higher for out of the money and near expiry options. Vega measures sensitivity to implied volatility. Higher vega means more sensitivity to changes in market volatility. Options closer to the money with longer time to maturity have a higher vega. Rho measures sensitivity to interest rate changes and is generally less important for short-dated options or low-rate environments. A trader expecting high volatility might seek high vega positions. Theta is a concern for option buyers as positions lose value over time. Delta-neutral portfolios can help isolate volatility bets. Gamma spikes near expiry, demanding quick reaction for risk control. Here's a quick summary of the Greeks, key metrics that help manage option risk. Delta shows how much an option's price moves with the underlying. It's used for gauging directional exposure. Gamma measures how fast delta changes. It's important for managing near expiry or at the money options. Theta tracks time decay. Option buyers lose value daily while sellers benefit. Vega reflects sensitivity to volatility. Higher vega means bigger gains or losses when implied volatility changes. Rho measures how options react to interest rate changes. It's more relevant for long-dated contracts. Together, these Greeks help traders adjust strategies, hedge risk, and stay responsive to market shifts. Many wealth management firms and conservative investors use covered call strategies to enhance yield in flat or moderately bullish markets. For example, an investor holding Apple stock at $180 might sell a $190 call expiring in 30 days and collect a premium. If the stock stays below $190, the call expires worthless and the investor keeps the premium. If it rises above $190, the stock is sold at the strike price, but the investor still profits from the rise. This technique is popular in portfolio management as it generates additional income while maintaining equity exposure. Rather than simply buying or selling puts and calls, traders and investors often combine options with stock or other options to create strategic exposure. These strategies help to limit risk, enhance income, profit in sideways markets, and hedge existing positions. Structure: long stock combined with a short call. Objective: generate income from a stock you already own. Risk and reward: downside risk is the same as holding the stock, reduced by the premium collected. Upside is kept at the strike price. Best for neutral to moderately bullish views. Structure: long stock combined with a long put. Objective, hedge downside while keeping upside open. Risk and reward, maximum loss is limited to the stock price minus the strike price plus the premium. Upside is unlimited. Best for long-term investors who want protection against short-term decline. Structure, buy a call and a put at the same strike and expiry. Objective, profit from a large move in either direction. Risk and reward, high premium cost since both options are purchased. The position is profitable only if the move is bigger than the break-even points. Best for anticipating high volatility events such as earnings or announcements. Structure, buy a call at a lower strike and sell a call at a higher strike with the same expiry. Objective, profit from moderate upside. Risk and reward, lower cost compared to buying a single call. Maximum profit equals the difference in strikes minus the net premium. Best for moderately bullish views. Structure, buy a put at a higher strike and sell a put at a lower strike. Objective, profit from a moderate decline in asset price. Risk and reward, define maximum loss and gain. It is cheaper than buying a single put outright. Best for moderately bearish views. This table summarizes common option strategies based on different market views. A covered call suits slightly bullish investors who want to generate extra income but are willing to cap upside gains. A protective put is for bullish investors who want downside protection while keeping the upside potential open. A long straddle targets big price movements in either direction, often used around high volatility events, though it requires paying a high premium. A bull call spread is ideal for moderately bullish views, offering a defined profit at a lower cost than buying a call outright. A bear put spread works for moderately bearish outlooks, limiting both risk and reward while being more cost efficient than a single put. Professional traders at proprietary trading firms and funds often seek consistent returns by selling volatility. One of the most popular strategies in these contexts is the iron condor, which involves simultaneously selling a call spread and a put spread on the same underlying. For instance, a trader may execute an iron condor on the S&P 500 index with strikes set outside a tight range. If the index stays within the range by expiration, the trader pockets the net premium as profit. This strategy is widely used in neutral markets where the goal is to profit from time decay and stable prices. Why use advanced option strategies? Advanced strategies allow traders to profit from volatility or lack thereof, reduce cost of directional bets, create defined risk setups, and capitalize on time decay and range-bound markets. Buy a lower strike call and sell a higher strike call. This is a net debit strategy with capped upside. Bear put spread payoff structure. Buy a higher strike put and sell a lower strike put. This structure profits from a moderate drop in price. Why use them? They offer lower cost than outright options and defined risk and reward. Straddle payoff structure. Buy a call and a put at the same strike and expiration. This strategy comes at a high cost but offers unlimited profit in either direction. Strangle payoff structure. Buy a call and a put at different strikes with the same expiration. It is cheaper than a straddle but requires a larger move. Use cases include earnings announcements, central bank decisions, and major news or volatility spikes. Structure. Sell an out-of-the-money call spread and sell an out-of-the-money put spread. Goal profit if the underlying remains in a defined range. Maximum profit, net premium received if all options expire worthless. Maximum loss, the difference between strikes minus net premium received. Best use, low volatility, range-bound environments where time decay, also known as theta, works in your favor. All advanced strategies must be sized according to volatility. Margin requirements differ based on net exposure. Rapid moves near expiry can cause gamma risk, especially in spreads. Selling spreads always carries defined but non-negligible risk. Monitoring Greeks like theta for time decay, vega for volatility, and gamma for the rate of delta change is key to managing multi-leg positions. These strategies give traders more precise ways to profit in various market conditions. Bull and bear spreads manage directional bets with lower cost. Straddles and strangles aim to capture big moves from volatility. The iron condor is best when expecting stable prices, offering income with controlled risk. These strategies give traders more precise ways to profit in various market conditions. In 2021, Archegos Capital Management collapsed after taking large leveraged positions in a few stocks using total return swaps and synthetic exposures, including options. The positions were built without appropriate hedging or transparency, leading to massive losses when stock prices moved against them. This event highlighted the danger of excessive leverage and poor risk oversight when using derivatives. Even sophisticated tools like options can become dangerous when used without a disciplined risk framework. The lesson: options offer power and flexibility, but also demand structured, scenario-tested risk management to avoid catastrophic outcomes. Options offer high leverage, asymmetric payoffs, and exposure to multiple risk dimensions, all of which can result in substantial losses if not managed properly. Key reasons to focus on risk include avoiding large losses from directional bets, controlling exposure to volatility and time decay, protecting capital and portfolio integrity, and building confidence in repeatable strategies. Maximum loss refers to understanding worst-case scenarios for every position. Break-even point means knowing where the trade becomes profitable. Delta exposure involves tracking how much directional market risk exists. Vega sensitivity is important because high Vega positions can swing rapidly with volatility. Beta decay describes how option value erodes over time, especially near expiration. Margin and liquidity require ensuring enough capital to withstand daily price swings and meet margin calls. Diversify across asset classes and expiries. Monitor Greeks at the portfolio level, not just per trade. Use scenario analysis such as what happens if volatility spikes or if markets drop 5%. Cap total exposure and avoid overconcentration in any single option type or strike. Stop loss orders help exit positions automatically at a certain level. Position sizing rules involve risking a fixed percentage of capital per trade, such as 1 to 2%. Hedging means using other options or underlying assets to neutralize unwanted risks. Rolling options allows extending or shifting positions as market views evolve. Monitoring tools include platforms with real-time Greeks, margin calculators, and volatility tracking. Options are not only for traders, they are core tools in modern portfolio management. Protective strategies involve hedging equity portfolios with puts. Yield enhancement strategies include covered calls in retirement accounts. Event-driven positioning means using spreads around earnings or central bank events. Tail risk hedging refers to buying out of the money puts as insurance against market crashes. Ultimately, success in options trading is not just about picking the right direction, it is about structuring risk so that even when you are wrong, you are still in the game.